Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome to today's episode, where we will unpack the CFPB's November 7th request for feedback on the proposed rule on digital payments oversight. Please join me in welcoming Andy Lorentz. Andy has been named one of the country's top fintech lawyers for payments and lending, is the founder and co-chair of the fintech practice and a partner at Davis Wright Tremaine's Washington, D.C. office. Andy, welcome.
Thanks very much, Ed. Great to be here.
Please also welcome back to the Risk Intel series, Ryan Richardson. Ryan is a former lead partnership counsel for a fintech, as well as a former regulator, and presently a partner in Davis Wright Tremaine's New York City office. Ryan, welcome back.
Thanks very much. Glad to be here.
Gentlemen, thanks again for joining us today. Let's start with a bit of context. While delivering the keynote speech at the American FinTech Council's annual policy summit in November in Washington, D.C., Director Chopra stated that the proposed rule on digital payments oversight doesn't represent a change in jurisdiction, but rather a change in oversight, indicating that this is a supervisory issue really that is presenting itself now. So let's assume for a moment that this is within the scope of the CFPB to engage here, and let's jump into the rule itself. So Andy, maybe you can kick us off here with a quick introduction to what the rule itself proposes, what are the goals and objectives of the rule, and who's expected to comply with the rule itself.
Sure, I'd be happy to, Ed. So the rule is basically an exercise of the Bureau's authority to designate larger participants in a particular market. And that's a way that they can extend their supervisory jurisdiction, just as you were saying, Ed, in the intro. This is the sixth in a series of those kinds of rulemakings that the Bureau has undertaken. Some of the other notable ones include, auto finance area, and the maybe most directly applicable or relevant is the international money transfer, larger participant rulemaking that they undertook. So the basic notion here is the Bureau will have authority to look at. Once it really is a pretty simple rule. It's all about market definition, right? It's all about defining what the scope of the market is, what the nature of the product or service is, and then establishing a threshold for a level of activity that qualifies you as a larger participant. And the actual activity that they're focusing on is, as you said, digital payment activity. So consumer digital payment activity. For payment, those that provide, consumer-oriented digital payment applications are the ones that are potentially subject to the rule. And the numerical threshold is pretty simple and pretty low from the feedback we're getting. Yeah. So maybe a little bit more about, what they mean by payment application, Ed, if that makes sense.
Yeah.
It's a pretty expansive definition, actually, and includes some elements that are a little bit maybe surprising. Obviously, the Bureau did a lot of research, including outreach, and exercising some of its other authorities to learn about this market. But, parts that are, you would expect the first element of the definition is funds transfer. And most of us in the payments world think we know what a funds transfer is. Well, the Bureau talks about funds transfer in this context in two parts. One is the part that we know and love, which you'd be touching the money or you're actually effectuating the money movement. But the second part has to do with initiation of payment instructions, and that's a little bit different. Certainly, that's not the kind of element that people would expect would trigger money transmission regulation, for example. So that's the first half of this digital payment application definition, all under the rubric of funds transfer. And then the second half is the wallet functionality. And this, almost in its entirety, is a little bit surprising in some respects, because this encompasses simply the activity of holding and allowing the consumer to initiate the authorized transactions through credentials that are held in a digital wallet. And those have been, quite ubiquitous. The Bureau ends up having to do, various numbers of exceptions and exclusions. One in particular, to exclude just something as basic as, merchants have been holding cards on file for since the dawn of the internet, right? Since they were able to get, Ryan, anybody to actually put their credit card into the internet. I'm old enough to know when that was a really, really terrifying thing for people to do. So that's a little bit unusual, and we'll talk a little bit about what these kinds of scope issues maybe introduced into the equation.
So in terms of that, the breadth of who is expected to comply, right? Andy, you talked about, right, there's a transaction threshold there. So it's dynamic here, right? Right, you could have new players and participants coming in, and once you hit that threshold, then I don't want to, maybe I shouldn't say you have a target on your back, but you're under scrutiny now. You're certainly under supervision.
The Bureau uses, without irony, effectively the argument that you should welcome this oversight because it will help you save money as a provider down the road, because we will help identify, any compliance issues before they metastasize into anything, really problematic. So we're going to save you money by supervising you as part of it. Ryan and I have been talking, a bit about some of the other ways the rule is kind of a bit more expansive. And one is that even just with the transaction count, the rule's very clear that the Bureau is going to aggregate across affiliates. And the affiliate definition, I just went and refreshed my recollection, and the regulation, the larger participant regulation, is set at 25%. So, if you are doing payment application activity in a related company, a company that qualifies as an affiliate, the Bureau will aggregate for purposes of determining, if you're caught by the threshold. And presumably that then works in the other direction too, right? If you have an affiliate that does 10 transactions a month and you have the primary activity of, 4 million, I can't do the math, 900,000 plus, right? In the primary, you would still subject the one that had, just a tiny amount of activity to Bureau supervision, because you'd aggregate across the affiliate. So there's some interesting ways to potentially be caught here that, people are going to really have to pay close attention to. I don't know, Ryan, if you have a reaction to that.
No, I think that's exactly right, and I think one thing that observation raises, or one question that observation raises, is about the estimate that is included in the rule about the number of entities that the Bureau expects are covered here, and I think the number that they call out in the NPR is 17. And certainly the sort of feedback that we're hearing from folks that are like sort of potentially caught by the rule is that the 5 million annual transaction threshold is quite low, and in fact that as a result that it may be well in excess of 17 entities that are caught by the potential coverage of the rule. The Bureau did great research, I think, in preparing to issue the proposed rulemaking, but I think the source of their research, at least as they disclose it in the rule, was on money transmitters and money transmission reports as a primary source of research. And I think what we're finding is that by the many different sort of prongs of the definitions of potential coverage here, that there are many entities that are not state licensed money transmitters that may be caught here. And so I think the question that naturally raises is like, how many more than 17 are we actually talking about? Is it just 34, or is it 50? Is it 100? It could be quite a large number. There's not a really great sort of scientific way to evaluate this across the market right now. But we certainly expect and hear that that the trade associations are trying to help tabulate those numbers as we speak. So stand by.
Yeah. All right. So whether it's 17, 50, 100, right, the number will fluctuate, and maybe the threshold ends up moving as a result of comments during the comment period here. But that's who's captured by the rule. What's then the implication, Andy, if you are covered by this rule? What does that mean from a supervisory and an oversight perspective?
Yeah, it's a great question, and really gets to the heart of, I think, what the Bureau's purpose was to to level the playing field in their terminology among the technology companies and the depository institutions. And they have a real perception, not only that that consumers are becoming increasingly reliant on these payment applications, and I think they're absolutely right. The numbers have been growing greatly, and that's eating into payment volume, right, that would have normally flowed through bank rails historically. So you have that aspect on the one hand. On the other hand, the technology companies, and Ryan and I have been kicking this back and around for various clients. A lot of technology companies, especially those that are, a number of them are very avowedly fintech. Other ones, like we don't know names, but there are the Magnificent Seven, right, in the Nasdaq. They even those ones are doing many things in financial services and as service providers, effectively, right? They don't view it that way, but of course the bank regulatory scheme views it that way because they're partnering with banks, and it is bank products that are, for example, sitting inside of a wallet, typically, right, a digital wallet. And that activity of being indirectly supervised as a service provider to a bank is, presents challenges, and it's been something that the technology companies have grappled with. And I think, my observation over the last 15 years is they figured out a lot of the parts to that, to how to manage it. But what I'm also seeing, as they get deeper into the ecosystem, as, for example, things like cloud for financial services becomes more ubiquitous, and those technology companies actually have to subject themselves to direct supervision, that even though they have reams of compliance documentation and product documentation and processes, et cetera, that are all wired to respond to the indirect supervision that's flowing through their bank customer, by and large, they're just not set up. They're not equipped. They're not nimble, especially the big ones, to manage this kind of process well. So I think it's going to be I think the Bureau's right. It is going to be quite a big sea change to have a compliance management system, for example, that's got to cut all the way across the enterprise to cover, everything that consumer, financial product or service related that, that company is engaging in.
So Ryan, I'm gonna actually park Andy's comment there for a second about direct versus indirect, because I think that's a really interesting theme for us to pick up on. But Andy, before we leave the implication there for these non-bank companies, one of the things that we talked about previously is the fact that now that the CFPB has a reason to be on site, now they're in the door, right? They now have free reign to a certain extent, right? And so I think to your point there, right, having those systems in place, or that perhaps you didn't think you needed or you didn't have in place previously, everything is up for grabs. So your controls and your systems need to be at a different level throughout the organization, perhaps not just in the money transfer, for example, or money transmission space that is originally intended to be the focus of this rule.
Yeah, it's exactly right, Ed, and it's interesting. The Bureau makes comments in the rulemaking to the point that the rulemaking itself is simply an exercise of supervisory jurisdiction. It does not create any substantive requirements, right? It doesn't change the underlying substantive consumer protection laws.
Right.
But what's interesting when you think about wielding supervisory power and having that power to do that directly, it brings directly under the microscope of the Bureau, the rest of the Bureau's agenda that, loosely under the umbrella of UDAP, because there's even more than that. But, if you look at things like their campaign against so-called junk fees, right, their campaign to extend, fair lending standards through the magnifying glass of UDAP to any kind of consumer financial product or service or activity. And so, those kinds of things are going to be brought to bear directly in a supervisory context. where the agency has all the soft power that is available to a supervisor. And I heard somebody describe it, Ryan, as, it's everything from, the raised eyebrow, which I can't really do. I'm not so fluent with my eyebrows. I can't wiggle my ears very well either. But, to all the way up to referring to enforcement. Right. And by the way, enforcement's down the hall. Right. Others know how the Bureau is architected much better than me. But, the fact that it's all housed in the same agency was part of the battle that was fought in 2009 and 2010, when the single mission agency was created. So,
yeah. And I think just one point to layer on that, which is that this is the scope of supervisory authority reaching beyond just the point of entry for being a larger participant is borne out over the other 5 larger participant rules that are in the market today. And we certainly have seen this play out in real time. I think in the first couple of these larger participant rules, we saw a good deal of back and forth, particularly in comments. But even sort of as the rule was sort of spinning up and being implemented after the comment period, that the scope of supervision should be limited to the consumer financial products and services that were the point of entry for being a larger participant in a market defined by a larger participant rule. And that just wasn't the way that the Bureau has played this out. And sure enough, the statutory authority for the CFPB to supervise larger participants in certain markets is for compliance with consumer financial laws and regulations, or laws and regulations applicable to consumer financial products and services. And it does not by its terms limit the scope of that authority to the particular market in which a particular entity is a larger participant. So I think this is something that I think we should feel confident will happen as this large, in whatever form this larger participant rule ends up taking, that the scope of supervision will be broader than just the activities covered by this rule.
Yeah. Well, so then let's take that. Let's build on that and go back to this direct versus indirect point, and it certainly ties into this concept of scope of reach of when the Bureau is inside an organization. How important is that distinction when you cross over? Because many of these non-bank larger participant institutions have been indirectly monitored by the regulator, right? They've been an arm's length partner, but they've been working with a regulated financial institution. So is it really that big of a deal that now they've moved from indirectly regulated to directly regulated?
I think the big deal is all in relative terms, of course. But I think you are exactly right. I would say that probably almost all, if not all, of the 17 participants that the rule is considering or covered here partner in one way, shape, or form with a financial institution to offer some products and services to end users, and in many cases, end consumers. So these, the entities that the Bureau is considering as covered here, are accustomed to their regulatory architecture as a service provider to a bank, and needing to have a compliance management system and other architecture designed to accommodate their role as a service provider to a bank. And certainly as a service provider to a bank, there's always the possibility of a regulator sort of reaching through the bank and directly examining a service provider. But that's, in practicality, that's pretty rare. You certainly see some very large service providers. Yeah, like some very large service providers that cut across many different financial institutions are occasionally examined for their role across the ecosystem. But it doesn't happen super frequently. And I think at least two things are really important here. One is that in the context of the bank being examined, typically the fintech partner's role in that is production of documents and response to questions and that sort of thing. But there's never actually direct interaction with the regulator, or very rarely is there direct interaction with a regulator. Sometimes the fintech will come in to respond to certain questions specifically about the programs that they're running with the bank, but even that is pretty rare. So there's a sort of an arm's length degree of remove in participation in the examination process. And the other piece of this that's important is that most fintechs that work with banks view their potential like, immaterial or even material violations of laws that apply to the bank as a contractual issue and a relationship issue, and not itself a legal issue. And so I think by virtue of now being directly supervised, that will change that framework slightly. Like that it will bring closer to the rails the idea of true legal and regulatory exposure for these fintechs who historically have viewed their exposure as a matter of contract for their relationships with their bank partners, correctly or incorrectly, by the way. So I think those two things will shift here. And I think as a result, I do think that some of these non-banks that will find themselves covered by this rule will sort of not only need to rework their compliance management architecture to be sort of more robust across the enterprise and not specific to the particular product verticals that are supported by a particular financial institution, but also sort of open their eyes to the possibility that there's direct litigation or direct enforcement exposure versus the indirect contractual exposure, or more frankly, or more likely, sort of indemnification exposure in the event of some sort of compliance or regulatory issue that arises under a bank partnership.
And we've heard, Ryan, some clients express a view that from the legal or compliance perspective, that there are some salutary aspects to that new state of affairs, right? Yeah. In the sense that there will need to be a renewed emphasis within these enterprises on, across enterprise sort of perspectives. And as you said, re-architecting the compliance management system and uplifting, to meet these new expectations. I think, and it fits certainly the Bureau's agenda of the leveling the playing field agenda. I think we do, worry a little bit about the range of activities that are going to have to be looked at. The ability to have a level playing field when you're looking at activity that is so disparate, and whether the Bureau will be up to the task, how long it will take, the market will continue to morph. What's the impact on, potential new entrants? And, some of these activities have been relatively low barrier to entry, heretofore, and that's going to change. You're going to have a certain scale, to be, because, in order to play. And so what is the impact on the competitive landscape going to be? Is that all going to ultimately shake out to the consumer's benefit or not? I think all that's TBD.
Yep.
Yeah.
I think the one other thing that I would layer there is, I think in the bucket of important unanswered questions is the degree to which the Bureau's authority here in supervising for compliance with consumer financial laws and regulations will reach the activities that a fintech is performing in its capacity as a service provider to a bank. I think it stands to reason to me that it shouldn't, but I think there's also an argument that it could and should. And I don't think that the rule clearly answers that question. So I think that's one thing that hopefully we'll see raised in the comment process. And I know that a lot of fintechs and banks are thinking a lot about right now.
Yeah, I mean, because the authority certainly for covered person, right, in the larger participant regs, covered person is the person providing the reg and all the product or service, and it's also an affiliate, right, to the extent it's providing services to that covered person. So yeah, query and Ryan, you and I go through this, ad nauseum in an awful lot of different transactional contexts. The degree to which who's providing services to whom in any particular context is not always so clear.
Right.
So
let's inject here this topic. We haven't really touched on this topic yet, but I think it certainly is germane to the conversation of the security angle. And Ryan, I know this was near and dear to your heart. You brought up this topic that IT and PCI, right, and right there has been an approach to thinking about the custody of credentials and this type of information as a security issue, rather than a consumer protection issue. And so then I wonder, right, what are the what is the clearly there was a gap.
Yep.
Right. Something right was not sufficient there. But the security controls and guidance is pretty tight. So can you explain that gap a little bit?
Yeah,
Right?
yeah.
Why does this need to even be here?
Yeah, well, I think that like that is the $64,000 question, right? And like you mentioned like there was a gap, or sort of, or was there a gap?
Right.
I don't know that this is clearly answered. And I think specifically what you're referring to here is in the wallet functionality prong of the definitions here, and in particular, sort of the act of storing credentials. And Andy sort of described some of this at the start of our conversation. Yeah, and I think historically, sort of the act of storing credentials and using those credentials to submit future transactions, what we sort of historically referred to as card on file, or what network rules refer to as sort of unscheduled credential on file transactions, have that is not itself a consumer protection issue, but is largely an IT and security issue, and that. Like there certainly is like a consumer protection element in that it can be used to initiate a future transaction. Either the merchant can initiate it or the consumer can initiate it, but pursuant to the terms of whatever agreement exists between the merchant and the consumer. But other than that, like the act of custody is about security, and and like the security laws and regs around holding these types of credentials as a service provider to a financial institution, and even apart from a service provider relationship, just the requirements that apply to the act of holding card credentials in particular are governed by the PCI data security standards. And, like those are pretty robust, and they have been generally effective in the market. We certainly hear, occasionally about major breaches, and like there's a lot of buzz around that. But in the grand scheme of the number of market participants that are holding and using these credentials safely every day, the occurrence of errors thanks to PCI is actually quite low. And so I do think the question is, what is the gap that this rule is trying to fill with respect to wallet functionality? And in particular, just the act of holding credentials and being able to use those credentials to initiate future transactions. And like, is there a consumer protection element of this that was not adequately addressed by existing standards on data security and just network rules generally, and other scheme rules, notcher rules, et cetera, about how those credentials not only are stored but used? And frankly, I don't see a huge gap that is left to be filled. Though I think that the contours of that gap, if there is one, are going to really play out over the comment process. And so this is something I'm just really interested to see the industry feedback on, and in particular, the consumer advocate feedback on, to help us figure out where the gap is that the Bureau is trying to plug. And I'm curious if you have any different or additional views on that one.
I think it's exactly spot on. It's so interesting, that the rule reaches this activity, and it sort of highlights for me the challenges the Bureau is going to face in looking at all these and trying to level a playing field across these kinds of providers, because even within even if you go to something that has might have funds transfer, maybe fundamentally the instruments are bank issued and so subject to Reg E and Reg Z, because they're all these are consumer transactions, right? So from the bank perspective, they are already covered by the core consumer protection regs. If you go the next step and there's a staging, right, of the funding, in between, you have an intermediate layer of Reg E protection typically. If you're talking about buy now, pay later and credit transactions, there's a state licensed lending overlay often, or there are all kinds of Reg Z and other kinds of closed end, typically kind of consumer protections that are brought to bear. So and then all the way up to straight up money transmission, right? There's both federal and state and Reg E overlays there. So there's a real panoply of rules that are already applicable to these transactions, and trying to sort through that without upsetting some existing scheme seems like it's going to be a big challenge.
Yeah. Let me adjust course one final time here, and then we'll close out with a closing question. But we're talking here about the large participants, previously unregulated, now getting, having some oversight in place. Is there an implication for, the regulated entities, right? For those financial institutions that are currently accustomed to dealing with the prudential regulators, and have existing schemes that they're accustomed to. What does this mean for them? It might be that perhaps it's not an answerable question right now, but any thoughts on the implication of this really from the regulated entity side of the house?
Andy, you want to take the level playing field part of this, and I'll take the other piece.
Yeah. So principally, you'd be thinking of the depository side, Ed, in terms of the currently regulated ones, or
Yeah.
I think I think certainly the banking community is probably fair to say has been looking for this sort of intervention, but by the Bureau due to perceptions that there were gaps, and I think it's interesting that, we talked a couple of times about the Bureau having done homework here, including outreach, right? Mandatory outreach to the and it also is compelled or required under its supervisory authority to do a lot of coordination. Sometimes I wonder whether with other regulators, both federal and state. And sometimes I wonder, Ryan and Ed, whether that is a limitation on the Bureau's authority or really an extension, because there's an awful lot of information sharing, I'm sure, that goes on and should go on. So, I mean, I guess all that to say is that, and there's also this element, right, Ryan, of there's so much cooperation, but you don't have these sorts of arrangements without a lot of cooperation. And so, there's that element as well. So there's not I'm sure the banking community in general doesn't want to see, the larger technology companies completely disabled from innovating in this space, because it's been a really great way to reach, customers, where they are.
Yep.
Right. From the consumer, right? The consumer is benefiting, right? In theory,
absolutely,
right? Through this
exactly
innovation.
Right.
Yep. And I think the one other sort of slight perhaps tangent that I would tack on to your question, is in the sort of in the bucket of unanswered questions, is what it's going to mean for the potential that certain fintechs will be regulated or supervised by the CFPB, and that the banks that they partner with to provide certain products or services would themselves not be subject to the direct supervision of the CFPB, but instead their consumer financial protection supervision is by one of the prudential regulators, FDIC, OCC, or Fed. I'm sure there are limited examples of that existing in the market today, but I think it's pretty rare. It doesn't present any sort of legal impossibility, but it's a new type of coordination, or at least a coordination muscle that I'm not sure is particularly well toned, and I think one that the market will need to calibrate to, and particularly if the rule ends up playing out as it's currently proposed.
More to come, clearly, on that point, right? It will be interesting to see how that does play out.
To the point of information sharing, one could see a certain amount of information flowing from the Bureau to the prudential regulator of that partner bank.
Yeah.
Yep.
Right?
Yeah.
As a consequence of digging into this activity at the fintech.
Yeah. All right, I'm going to ask you guys for a bit of free legal advice, or maybe I'm going to get a bill at the end of this. I'm not sure. What are you advising market participants to do at this point? Right, we've got a period of time ahead of us where this rule is open for comment. What are you, Ryan? What are you advising your clients? Andy, what are you advising your clients on what to do at this point in time, given where we are in the cycle?
Yeah, I mean, I think the important part here is to think about how you want to comment. do you want to comment directly under your own name? Do you want to work through a trade association? I think like there are clearly pluses and minuses to each of those, and like different considerations for different market participants about how they want to couch their feedback. But this is the opportunity to provide it. And this rule is drafted sufficiently broadly. And I think we talked a lot about the unanswered questions here. I think there are many gaps in the rule, and not necessarily like coverage gaps in the rule, but sort of
open questions,
implementation gaps in the rule that need to be addressed. And the way to raise those questions to the Bureau is through the comment process. And so I think the conversations that Andy and I are having with a lot of clients right now is about how do you want to frame those comments, and how are you going to sort of deal with that through the trade press or trade associations or the like.
Yeah, I would agree. And I have the benefit, Ed, of being able to ride shotgun with Ryan on a number of these conversations with clients. So, benefit from his insights in real time. I'm in addition to the process point, which is so critically important, how you go about it, because you can't put that genie back in the bottle. If you have raised your head above the rim of the foxhole, on a particular issue, you're in the gun sight, so to speak. So it is the need for study, the need for study of the rule, obviously, but study for sort of the tendrils of the rule in terms of what do your service provider relationships look like? What does aggregation look like? As I think I mentioned earlier, Bureau is going to aggregate activity across affiliates. Affiliates have a low threshold definition. 25% ownership is enough to trigger that that affiliate definition for supervisory jurisdiction purposes. And so you could be opening the door. You want to look at your enterprise risk and the way you're offering your product mix, through different legal entities and how that's all architected, to try and minimize your surface area that would be exposed to the Bureau's supervisory authority. I think that's really, really important. And Ryan's always very, very smart about this particular aspect too. Is in terms of your roadmap, don't take a dynamic view of your situation. Don't just think about statically, this is what I'm doing today. Think about what you want to do in the short, medium, and longer term with your company. And that should inform your strategy. You're going to have to live with the Bureau anyway for some other reason, or you're going to always, can you be maybe remain free of their tender, clutches for perpetuity if you can fight this off. So,
thank you, gentlemen. Extremely thoughtful comments, great discussion, and I really appreciate you sharing some wisdom, providing us a bit of the lay of the land, right? View into what you're hearing, right? You going a bit beyond just the black and white print there, and the interpretation is incredibly valuable. And also helping people really think about, to use your phrase there, Ryan, some of these unanswered questions, some of the things that are going to apply, perhaps differently from one institution to another. And I think that this question in particular of the implications for the depository institutions and right, what does it mean, beyond the 17 or 50 or 100, large participants here that are impacted directly. Clearly there's going to be a knock-on impact for, people who are now have partners that are supervised directly and the downstream impact of that. So thank you very much, Andy. Greatly appreciate the time. Brian, it was wonderful to have you back, and hopefully we'll have you guys back on sometime soon. Thanks again.
Thank you.
Thanks.
Take care.